Okay, here we are again. Today we're talking, in this video we're going to talk about really the actual real magic of this infinite banking concept or type of a thing. And it is really in the loan versus the withdrawal. Okay? The fact that you can take a loan against your account versus a withdrawal out of your account makes all the difference in the world. Now, there's lots of different things about these policies that make a lot of sense, that are smart, and whatever else. But the fact that you can take a loan against your account versus a withdrawal is really the actual where the magic is. Okay, and I'm going to illustrate this here. And so, if we took this traditional investment, okay, someone had a traditional investment, and someone say $500 a month at 7% for 30 years, it'd grow to $566. Okay, so now let's say they're retired, and you have they want to take $67,000 a year as an income. Okay, I mean, you can use these policies in many different ways. We're just looking at it from a retirement perspective. Okay, now the $67,000, depending on taxes, is going to be gone in about 7 to 13 years. Right, so they saved it for 30, gone in an average of 10. All right, so the only way to overcome that is to really take out less, right? And so it extends out the time or get better return. But in a traditional type of an investment, there's no guarantee of that. In fact, in retirement, the chances of getting a 7 in a typical conservative, mainly bond, some stock mix, right, is probably going to be more like 4 to 6%, type of thing. You're probably not even going to get that 7% on a consistent basis. So when the withdrawal mode, where you're taking money out, not only are you going to probably have lower return than 7, but you also don't have any guarantee against loss. So we just really don't even know exactly how long this will typically last. Right? So, but either way, it's not, the point is, with taxes or no taxes and a 7% return, it still disappears 7 to 10 years, right? Assuming no losses and everything. Whereas with this IUL or Index Universal Life, same money in, but let's say you get to 523 instead of 566 because a portion of your $500 a month was actually paying for a life insurance policy along the way, right? So additional perk is that you have life insurance, still have life insurance over on the other side, that we're not including any life insurance. But that's kind of an aside here to what I'm explaining here. But so it goes to 523, but it's not how much you accumulate, it's how much you get to spend, right? Aren't we just saving and investing today to spend it at some other time, right? I mean, ultimately, we're saving to spend. So it's not about how much you can grow your money. It's about how much you can spend. It's just the assumption that the more money I have, the more I get to spend, right? But that's not always true, because here we accumulate 523. We take $67,000 a year as an income, but we take it as a loan against our account versus a withdrawal out of our account. Okay? As a result, what happens is that now that $67,000 ends up lasting the rest of your life tax-free by taking a loan against the account versus a withdrawal. Now, some of you might be, well, man, that's the same money out of pocket. How is that possible? Right? Well, let's dive into the numbers a little bit, okay? And so here's an example here. Of the 500 a month or 6,000 a year being put into the Index Universal Life, okay, at 65 in this scenario, you're at 523, okay? When you take a $67,000 loan against it versus a withdrawal type of a thing, and you continue to do that. Well, look at the account value here. 523, 563, 607, 64, 75. It continues to go up. Why? Because you're not actually taking money out. So if we look at this kind of like a home and a mortgage, right? A home and a mortgage, the value of your home has nothing to do with your mortgage, right? The mortgage just determines how much equity you have if you were to sell it, okay? But it has nothing to do with the value of the home. Well, here we have this account value, and we have the spendable cash. Spendable cash in this sense is that equity, okay? So as your account grows, or the value of the home, so to speak, grows, as you put this quote-unquote mortgage, it's not really a mortgage, but as you put this mortgage onto your account, what happens is that your spendable cash or equity slowly goes down. Not in proportion, right? Because your money or account's still growing, but in small, this drops about 30,000, but you took 67 as a loan, right? So it slowly over time goes down, and then what happens is that you hit this crossover point. In this example, at age 86, it gets down to 111, but then it goes up to 113, 18, and continues to grow from there, right? How does it do that? Well, it's because look at the size of your account now. Now you have $2.5 million in your account that's generating interest for you, right? Because you're not taking any money out of the account. The money stays in the account, continuing to grow and generate interest, right? So as a result, you have $2.5 million that's growing in this example. They're here around 7%, okay, type of a thing. And so as a result, the interest gained starts offsetting any mortgage, so to speak, interest that you're accruing. And so you always have equity. So if you think about the home and mortgage scenario, if you were to pass away and you had a mortgage or a home worth $1 million, but a mortgage worth $700,000, is your family going to get $1 million? No, they're going to pay the loan off first, take the difference, and that's what passes on to the family. Or if you were and so here in this example, people ask all the time, well, what's my death benefit? Well, we don't really have a death benefit column in here, but let's just say it's like a $300,000 death benefit or a $500,000 death benefit. What typically happens, depending on how you structure things, is that the loan gets paid off by your account value. The difference in this, let's just go up to age like 75, right? There's 1.1 million in the account, 260 in the thing. So the 1.1 million pays off the loan. 261 that's left in your equity is then added to say that death benefit. Now sometimes that it's not typically just structured that way, and so people don't always get the cash plus the death benefit. But there are ways to be able to do that, and structured properly, you can get the biggest benefits out of this. Type of a thing. So if we compare this to a traditional retirement, right, where you're taking withdrawals, you can see you got 566, and then you take a withdrawal. Even with growth, the balance goes down, right? Continues to go down, and so then it's gone, right? It disappears after around 13 years without even any taxes and a consistent 7% growth. The money's gone. If we add taxes into that, it disappears even faster, and it's gone, like we talked about, in about 7 years, right? I'm sure there's more questions to this, but that's why it's important to reach out to me, and we can dive into a specific scenario that helps you. But subscribe below to be able to stay up to date on all the different changes and whatnot that's going on. But the power of the loan versus the withdrawal makes all the difference with this concept compared to your traditional type of savings plans. All right, talk to you later.